In less than 48 hours, silver did something markets are not supposed to do. It went from trading near $121 an ounce to the $70 range, and it didn't drift there, it snapped there. A move like that isn't just volatility, it's the sound of leverage breaking. And the timing matters. It wasn't months, it wasn't weeks, it was a compressed event, the kind that exposes weak joints in the financial plumbing. For years, the comfortable story was that silver is too liquid, too deep, too watched for anything truly abnormal to happen without warning. The idea was simple. Even if silver rallies, it does it in steps, with breathers, with orderly pullbacks. Then this happened. A record one-day drop, reports of a roughly 27% plunge, and suddenly the conversation wasn't about demand or inflation or solar panels. It was about forced selling, margin stress, and why multiple parts of the market seemed to hit the same wall at the same time. Here's the part that should make you pause. The public sees the chart after the fact. Institutions see pressure building before the chart breaks. They see it in margin models, in order book behavior, in delivery schedules, and the way spreads widen when they shouldn't. When a market moves like this, the real story isn't the price tag. The real story is what had to be liquidated to make that move possible. Now, what I'm about to lay out is not a prediction, and it's not a rumor. It's a pattern. And if you've ever wondered how markets can feel calm for months and then turn violent in a single weekend, silver just offered a case study in plain sight. Welcome to Roki Macro, where we decode what matters before it becomes the headline everyone repeats. If you like calm analysis instead of noise, consider staying close, because these are the kinds of shifts that change narratives fast. And tell me in the comments where you're watching from, because these moves don't hit every region the same way, and the geography matters more than most people realize. Let's start with what actually happened. Silver surged into an extraordinary peak, near $121 an ounce. Then, by February 2nd, 2026, it was trading around $77 and change, with the low prints flirting with the mid-70s. That is not a normal retracement. That is a mechanical unwind. It's what you see when positions are forced to close, not when investors calmly reassess value. At almost the same time, the Shanghai Gold Exchange issued a notice about unusually high fluctuation. This wasn't a vague social media warning. It was an operational message about risk management in the silver deferred contract, AGT+D. The exchange spelled out specific contingencies. If the contract became locked at the price limit, the margin requirement would be raised from 20% to 26% at the end of day settlement, and the price limit for the next trading day would expand from 19% to 25%. Why does that matter? Because margin is the gatekeeper of leverage. When margin goes up, the market instantly demands more cash collateral to hold the same position. If you can't post it, you reduce. If you reduce, you sell. If enough people sell at the same time, price falls. It's not a moral judgment, it's arithmetic. Now connect that to another piece of data most people ignore when they watch a chart. The CFTC's futures and options positioning data showed a stark imbalance in the commercial category. As of January 27th, 2026, open interest in the main silver futures contract was about 488,463 contracts, each representing 100 ounces. The commercial group held roughly 96,200 long contracts and roughly 344,485 short contracts. There are benign explanations for that. Commercials include producers and merchants who hedge physical exposure. If you produce silver or warehouse it or finance it, you may short futures to lock in revenue or protect inventory. That's normal. What's not normal is when that structural short sits inside a market that is simultaneously experiencing emergency margin actions and price dislocations so large that the entire market narrative flips in days. Now let's add a physical anchor, because silver is not just a number on a screen. In London, the main vaulting system reported on the order of 27,818 tons of silver at the end of December 2025, valued around $64.4 billion. That's a lot of metal. But it's also a useful reality check. Silver is a global market, yet the entire visible above-ground inventory in a major hub can be described in one line. When price moves the way it just did, the question becomes less about whether there is metal on Earth and more about whether the system that prices it is stable under stress. This is where the red flags begin to stack. The first red flag is speed. When silver goes vertical and then collapses, the initial move often attracts momentum and leverage, and the reversal often reflects a change in funding conditions, not a change in long-term fundamentals. Funding conditions can change because exchanges change margin, brokers tighten limits, or liquidity providers step back. Those are institutional levers, and they are usually pulled when risk models flash. The second red flag is coordination and timing. You don't need conspiracy to notice synchronized behavior. Markets are connected through risk. When volatility spikes in one venue, margin and collateral demands rise across the system. The trader who is long silver on one exchange may be short in something else on another, and the broker looks at the portfolio, not the story. If collateral is demanded, positions are cut where they can be cut. That can mean selling what is liquid, not selling what is overvalued. The third red flag is contradiction. The chart was screaming panic, but the institutional messaging was calm, procedural, almost clinical. It's the tone you use when the fire alarm is real and you're trying to prevent stampede. And the data underneath was showing that the largest categories of participants were positioned in ways that imply preparation for stress. To understand why this matters, you have to zoom out. Silver has a history of doing something unique. It can behave like a monetary metal, moving with macro fear and currency debasement narratives, and it can behave like an industrial metal, moving with manufacturing cycles. That split personality makes it especially vulnerable to dislocations, because different participants justify positions for different reasons. When those reasons collide, the unwind is rarely gentle. In 1980, silver became synonymous with a blow-off. Prices spiked to levels that shocked the public, and then the market cracked. The details of that era are different, but the structure rhymes. Concentrated positioning, leverage, and then changing rules around trading conditions that accelerated the reversal. In 2011, silver again surged and then experienced a sharp reversal amid tightening conditions, with margin hikes playing a role in forcing leveraged longs out. Different decade, similar mechanism. Fast forward to now. In 2026, we again see a rapid run, a sudden collapse and formal exchange steps aimed at volatility and leverage. That doesn't mean history repeats perfectly, but it does mean there is a known playbook, and the market is acting like it's reading from it. Here's where it gets interesting. A normal market move is explained by a single narrative. Demand rose, supply fell, price adjusted. But dislocation moves are explained by multiple narratives that fight each other. One camp says silver is in a new era, driven by strategic industrial demand, clean energy build-out, and physical scarcity. Another camp says the move was a speculative blow-off fueled by leverage, and the collapse proves it. The data shows something else entirely. Both camps can be partly right, because the short-run price can be driven by financial mechanics, even while the long-run constraints remain physical. The short-run price is often set in paper markets, where contracts can be created and closed with a keystroke, and where the marginal buyer or seller is a leveraged participant managing risk. The long-run constraint is physical, where production, refining, logistics, and vaulting create frictions. When those two layers drift apart, you get the kind of instability we just saw. It's a story about institutions and their rules. Start with the exchanges. The Shanghai Gold Exchange is a major venue for precious metals trading, with its own contract structures and risk frameworks. When it changes margin from 20 to 26% and expands the limit band from 19 to 25%, it's altering the speed at which losses can accumulate and the amount of capital required to stay in the game. That's not cosmetic. It changes behavior immediately. Then you have the broader derivatives ecosystem, where the CME Group's silver futures are a primary benchmark for global pricing. The CFTC data is a window into how categories of traders are positioned there. Commercial participants, swap dealers, managed money, and others each have different mandates. When commercials hold a large net short, it can reflect hedging, but it can also reflect the way the system supplies liquidity to speculative demand. When managed money is aggressively long, commercials often become the other side. Banks matter too, not because of a secret plot, but because banks intermediate collateral, lend against inventory, and clear trades. When volatility rises, banks tighten. They do it through higher haircuts on collateral, reduced credit lines, and stricter intraday margin. Those actions ripple outward, and they can turn a normal correction into a cascading liquidation. Regulators matter as well, because their reporting frameworks shape transparency. The CFTC reports tell you what categories hold, but not always the granular identities. That's enough to identify stress patterns without personalizing blame. When you see extreme positioning and then a volatility event, you can infer that the market was crowded, and crowded trades break fast. Now connect these institutional actions through timing. Price spikes, volatility rises. Exchanges respond with risk controls. Brokers respond with tighter limits. Traders who are riding leverage are forced to add collateral or reduce. Reductions mean selling pressure. Selling pressure triggers more volatility. More volatility triggers more controls. This is a feedback loop, and it's not theoretical. It's visible in the sequence of events. This is the part no one is discussing in mainstream coverage. The difference between a market that falls because value changed and a market that falls because the plumbing demanded cash. When you hear margin increased, think of it like a landlord raising the security deposit overnight. The apartment is the same, your income is the same, but if you can't come up with extra cash by tomorrow morning, you have to move out. That's what margin does. It doesn't debate the price, it changes who is allowed to participate at that price. Now, let's go deeper into the dislocation, because silver is giving you multiple signals that don't line up. First, paper prices can swing violently because contracts represent future delivery, not immediate physical exchange. Most contracts are closed financially rather than settled with metal. That means the supply of contracts is elastic. If traders want exposure, they buy contracts. If they want out, they sell. In a leveraged environment, that can create extreme moves without any immediate change in physical inventory. Second, physical silver is not infinitely flexible. It sits in vaults, is held by industries, is embedded in products, and moves through refineries with lead times. London vault totals, for example, represent a snapshot of a major stockpile. Tens of thousands of tons sounds enormous, but in a world of financial leverage, the notional exposure represented by paper claims can dwarf the physical base that anchors confidence. The metal can be ample while the market still becomes unstable because instability is about financing, not geology. Third, regional demand can diverge. When one region experiences tighter risk controls and expanded limits, it can alter local pricing dynamics relative to other regions. If Shanghai is widening limits and hiking margin while other venues are operating under different settings, the pathways for arbitrage change. Traders who normally smooth price differences may step back because the risk of limit moves and margin calls is higher. When arbitrage weakens, dislocations widen. So you get a world where the screen price says one thing, but the operational reality says another. That's the dislocation. Now let's lay out the evidence with numbers, because this story only matters if it's anchored. 1, the price move itself, from around 121 to around 77 in a burst. That's a swing of roughly $44. On a base of 121, that's a decline of about 36%. Even if you use slightly different intraday prints, the scale remains extraordinary. 2, the reported one-day drop, around 27%. Moves like that in a major metal are rare. They don't happen in calm positioning. They happen when a market is over-leveraged and liquidity is thin at the moment everyone needs the same exit. 3, the exchange's risk action. Margin from 20% to 26% is a 30% increase in required collateral. It's not a subtle adjustment. It's the kind of shift that forces immediate decisions. And expanding the limit from 19 to 25% is an acknowledgement that the prior band is too tight for current volatility, which means the exchange expects larger swings to continue. 4, the positioning asymmetry. Commercial shorts at roughly 344,000 contracts against long exposure of about 96,000 contracts, with open interest around 488,000. That tells you that one category is heavily on one side, and that the market is structurally built on offsetting exposures rather than balanced speculation. When markets unwind, these structural imbalances can accelerate the move because the side that must liquidate is not always the side you assume. 5, the physical anchor in London. 27,818 tons at around $64.4 billion. That's an average implied valuation consistent with late 2025 pricing levels. The precise number is less important than the framing. The physical stack has a finite scale, and the paper exposure can move prices by tens of dollars in days. That's the mismatch between the physical base and the financial overlay. Put those together and you get the central mystery. How can a market with visible physical stock and global participation still behave like a small cap meme stock for a weekend? The answer is that liquidity is not the same as stability. Liquidity can vanish when everyone wants to exit at once and collateral rules change mid-move. Now, what does this mean going forward in terms of analysis and what to watch? Historically, when you get a leverage-driven blow-off followed by emergency risk controls, markets tend to enter one of 3 paths. The conservative path is stabilization. Volatility cools, margin requirements normalize, and price finds a range while participants rebuild positions more cautiously. In that scenario, the key indicators are declining realized volatility, narrowing spreads, and a return of orderly volume. You'll also see exchange notices become routine again, not urgent. The moderate path is a second shock. The first liquidation removes the weak hands, but the market remains fragile because inventory flows, funding costs, or positioning remain imbalanced. In that scenario, price can retest lows or spike again in a short window, often around settlement dates, options expiration, or moments when liquidity is typically thinner. The indicators here are renewed spikes in volatility, repeated limit moves, and further margin adjustments. The aggressive path is a regime shift. That's when the dislocation between paper and physical becomes harder to ignore, and the market begins repricing not only the metal, but the credibility of the mechanism that sets the benchmark price. This can happen if delivery stress rises, if a major participant changes policy, or if cross-border flows create persistent premiums. The indicators here are persistent regional price gaps, unusual changes in vault stocks, and structural changes in open interest and positioning categories. Notice what's missing. There's no need for certainty. There's no need for dramatic forecasts. The pattern itself is enough to warrant attention because when markets behave like this, they're telling you about stress in the system. So what should you watch specifically? Watch margin changes and risk notices from major exchanges. They are the most honest communications in finance because they are operational. They are not trying to sell you a story. They are trying to protect the clearing system. Watch open interest and positioning reports, especially the relationship between managed money and commercial hedging. When open interest falls sharply after a spike, it often indicates liquidation. When it rebuilds quickly, it can indicate the crowd is returning before stability is restored. Watch volatility metrics. When daily ranges remain outsized even as price stops trending, it often means the market is still digesting a leverage event. Stability is not just flat price. Stability is narrow ranges and predictable flow. And watch physical signals as context. Vault stocks, premiums in different regions, delivery queue chatter from industrial channels, and any persistent divergence between spot indications and futures structure. None of these are perfect alone, but together they tell you whether the financial layer is reconnecting with the physical layer. This brings us to the final and most important part, the divide. If you're wondering why the move felt like it came out of nowhere, remember that markets broadcast stress quietly first. They do it through funding rates, through widening bid-ask spreads, through sudden reductions in depth, through brokers calling clients earlier in the day. By the time the chart looks obvious, the constraints were already active everywhere. Markets don't punish people for being unintelligent. They punish people for being late to information that was available in advance. The gap is rarely about IQ. It's about attention. Institutions don't have magic. They have dashboards, they have risk committees, they have margin models. When the model says collateral needs to rise, it rises. When it rises, the people who can post collateral stay in. The people who can't exit. And the price you see is the byproduct of that sorting process. The public tends to focus on the headline number, the peak, the crash, the drama. Institutions focus on the mechanics. Who was forced? What is the collateral timeline? Where's liquidity thick? And where does it disappear? If you want to understand why this wasn't a normal market, it's because the mechanics were driving the outcome. Silver just showed you a market that moved on pressure, not on persuasion. It moved because the system demanded cash. It moved because rules tightened. It moved because positions were crowded and then unwound. And that's why the red flags in silver can't be explained away with a simple story about supply and demand. The evidence is in the dates and the numbers, a rapid move from 121 to the 70 range, a record single-day plunge, a formal exchange notice raising margin from 20 to 26%, and widening the limit band from 19 to 25%. A positioning landscape where commercial shorts tower over longs, a physical base measured in tens of thousands of tons, while the financial overlay can reprice the metal in days. This is Roki macro, where we decode what matters before its headlines. If this connected dots you hadn't lined up before, you know what to do. And the real question isn't whether silver stays calm from here. The real question is whether the next move will be driven by fundamentals or by the same collateral mechanics that just reminded everyone how fragile leverage can be.